Hello viewers, this is Bhavna Mehra, and in the sequence of banking, today's topic is Methods of Credit Control by RBI, and this video is specifically covering quantitative methods. To keep an objective in mind, that is, to control inflationary trends and to boost economic growth, RBI administers control over the credit that the commercial banks grant to general public. The ultimate aim behind credit control is to bring stability in the real national income, and if RBI doesn't control this whole credit system, then it would lead to socio-economic instability in the country. So basically, credit control, which is also known as credit policy, is the lending strategy that banks and financial institutions use to lend money to customers, or it is a major weapon of the monetary policy used by RBI to control the demand and supply of money in the economy. Remember that during inflation, Reserve Bank of India tightens its policies to restrict the money supply, whereas during deflation, it eases the policies and allows the commercial banks to derive money in the economy. Now coming to the methods of credit control. RBI uses two methods to control money supply, and they are quantitative methods and qualitative methods. And as I have already mentioned, in this video I will be explicitly covering the quantitative methods only. So quantitative credit control means the control of the total quantity, volume or of credit in the banking system. It is also known as general tools of money control. General because it will affect all the loans without discriminating among the various sectors of the economy. And the other one is qualitative methods, which is also known as selective methods. Now coming back to quantitative methods, the important quantitative methods of credit control are: first is reserve ratios, in which we'll talk about CRR and SLR. Next is OMO, that is open market operations, and the third one is rates, in which we'll talk about bank rate, repo rate, reverse repo rate, LAF, that is liquidity adjustment facility, and MSF, that is marginal standing facility. First, coming to the reserve ratios. So bank keep aside a certain percentage of their total cash reserves or RBI approved assets. There are two types of reserve ratios. First is CRR, that is cash reserve ratio, and currently it is 3%, and second one is SLR, that is the statutory liquidity ratio, which is currently 18%. First, coming to CRR, that is cash reserve ratios. Banks set aside this portion in cash with the RBI. The bank cannot lend this amount to anyone to earn a profit or interest on CRR. So here at one hand, some amount of the banks is secured with RBI. Then on the other hand, it keeps inflation under control. As during inflation in the economy, RBI raises the CRR to lower the bank's loanable funds, and vice versa during deflation. In short, the higher the CRR, the lesser is the amount of money available to banks for lending and investing. Ensuring liquidity against the deposits is the prime function of the CRR. Thus, as the depositor, it is good for us to know about the CRR prevailing in the market, because it ensures that regardless of the performance of the bank, a certain percentage of our cash is safe with RBI. Furthermore, SLR is a specific portion of deposits in the form of liquid assets like gold, government securities, etc., which the Reserve Bank of India has mandated to every bank. Remember, unlike CRR, banks earn interest on their SLR. The RBI imposes a reserve requirement. It ensures that a particular portion of the deposits are safe and are always available for the customers to redeem. However, this condition also restricts the bank's lending capacity. In India, every bank, scheduled commercial bank, state cooperative banks and primary cooperative banks is required to maintain the SLR as per the RBI guidelines. If any commercial bank fails to maintain the SLR, RBI will levy a 3% penalty annually over the bank rate. Defaulting on the next working day too will lead to a 5% fine. This will ensure that commercial banks do not fail to have ready cash available when customers demand them. Always remember that the RBI ratios are counted on NDTL, that is net demand and time liabilities. When we look at any bank for business point of view, then a bank is basically a company whose aim is to earn profit. There is a process in banking system for circulating money, and that is banks receive money from depositors, which becomes their liability as they have to give it back, and lends that money to the borrowers and earns interest over these loans, so it becomes an asset for the bank. Now, to understand NDTL properly, we need to break down this net demand and time liability into two liabilities, and they are demand liability and time liability. Demand liability means whenever customer needs money, bank has to provide it. It is more clearly understood by the term CASA, that is current account, which is used for business purposes, and saving account. It means if customer is depositing money in these accounts, then it is his decision only that when he wants to withdraw this money. Demand draft, letter of credit, bank guarantees also come under this category. Unpaid dividends or overdue FDs are some other examples of demand liability, or OTDL, that is other demand and time liabilities. Next comes the time liability. It covers the deposits which a customer can only withdraw after a certain time frame, for instance FDs and RDs. Because if in between, even in urgency, the customer is withdrawing money from these accounts, then he has to face two losses, and those will be low interest rates and some penalties also. Cash certificates, mutual funds and gold deposits also come under time liability. Remember, time liability is always greater than demand liability because clients are earning more interest on time liabilities, therefore they prefer it. So basically NDTL is the sum of all deposits of a bank. Now we have understood this whole NDTL because without NDTL calculation of CRR and SLR is not possible. Now let's discuss the difference between CRR and SLR. So the CRR requires banks to have only cash reserves with the RBI. In the case of SLR, banks are asked to have reserves of liquid assets, which include both cash and gold. Next is, bank don't earn returns on money parked as CRR, whereas bank earn returns on money parked as SLR. Third comes, in CRR, the cash reserve is maintained by the banks with the RBI, whereas in the case of SLR, the securities are kept with the banks themselves, which they need to maintain in the form of liquid assets. And the central bank controls the liquidity in the banking system with CRR. SLR is used to control the bank's leverage for credit expansion. For combating inflation, RBI raises SLR and CRR. Due to the raised percentage, now banks are left with less money. Now to keep their profit margins same, banks need to increase their interest rates, and gradually it will decrease the demand of the money, and vice versa during deflation. Remember that CRR and SLR both are long-term credit control measures. When to control inflation, CRR and SLR are increased, then it is known as hard monetary policy. Next comes the OMO, that is open market operations. Under OMO, to regulate the money supply in the economy, simultaneous purchase and sale of government securities by RBI take place. RBI carries out the OMO through commercial banks and does not directly deal with the public. Government issues government securities in which they clearly mention the interest rate as well as when will it get mature. And if RBI is having sufficient money, then that money will be given to the government in exchange to these G securities. Otherwise, RBI will print money. So this is one of the way by which RBI provides funds to the government. Now, in case of excess liquidity in the market, RBI issues these securities via auction. Then some of these G securities will be sold to commercial banks and RBI will get money in exchange, so that it will curb the position of money supply to these commercial banks and bring the inflation down. Bidding takes place on the Reserve Bank of India CBS system, that is ECOBAY. There is no compulsion on the banks to purchase these G securities, but if the banks have idle money, which they have received through deposits, then they prefer to buy government securities as they can earn good interest on it and can manage their regular liabilities. So when RBI feels that there is excess liquidity in the market, it sells the government securities and buys when it feels the liquidity conditions are tight. Or during inflation, sells the government securities and buys during deflation. Third quantitative method is rates. So coming to bank rate, which is currently 4.25%. It is also known as discount rate. The rate of interest at which long-term loans taken by the bank from RBI against no collateral is known as bank rate. Yes, you heard it right. Against no collateral security, banks get this long-term loan from RBI. Bank rate is used as the reference rate by the banks, or we can say that bank rate policy is the policy under which RBI influences the volumes of credit in the economy by changing the bank rates. An increase in bank rate leads to an increase in other rates of interest and vice versa. So, for controlling inflation, bank increases these bank rates, which will in effect increase the interest rates of the banks for general public and vice versa for deflation. Next is LAF, that is Liquidity Adjustment Facility, and it is having two components, that is repo rate and reverse repo rate. The RBI introduced the LAF as a result of Narasimhan Committee on Banking Sector Reforms in 1998. Now we'll discuss repo rate. This is the interest rate at which the RBI lends money to commercial banks in case they need short-term funds to meet regulatory or business requirements. RBI in its first bi-monthly monetary policy for the year 2021 has kept the repo rate unchanged to 4%. This has been done to limit the damage to the economy caused by the second wave of COVID-19. When the RBI cuts repo rate, cost of funds of banks reduces. As a result, the banks are able to advance loans to their customers at a lower interest rate. Whereas increased our reverse rate to control the inflation, as it will also increase the interest at which the commercial banks are lending to the general public. So eventually it will reduce the money supply and somewhere will try to control inflation. Now, what is reverse repo rate? It is the interest offered by the central bank to commercial bank who deposit funds with them. For instance, when banks generate excess funds, they may deposit it with the RBI and earn interest on the same. This is another financial tool used by the RBI to control money supply in the economy. The reverse repo rate also stands unchanged at 3.35%. Remember, reverse repo rate will always remain lower than the repo rate because RBI cannot pay higher interest on deposits than charge interest on loans. This is to facilitate cash flow from RBI to central banks, which in turn will increase the purchasing power of the market. Let's see the impact in the market with the increase and decrease in the reverse repo rate. With the increase in reverse repo rate, the commercial banks can earn more interest on the funds deposited with the RBI. Thus, they prefer to keep surplus funds with the RBI instead of letting it out in the market. RBI does increase the reverse repo rate to cut out excessive liquidity in the banking system. And when RBI decreases the reverse repo rate, it infuses liquidity in the banking system. With the decrease in RRR, banks will earn less on their excess money deposited with the RBI and therefore will prefer to lend that money out in the market. Next is MSF, that is Marginal Standing Facility. It is the rate at which scheduled banks borrow funds from the RBI in emergency. So, in emergency, when interbank liquidity dries up completely and they face acute financial shortage, then Marginal Standing Facility is a window for banks to borrow from the RBI. The minimum amount for which RBI receives application is rupees 1 crore. By reforming the monetary policy in 2011 and 12, the Marginal Standing Facility was launched by RBI. MSF rate has undergone several changes after its introduction, as RBI reduces or increases the rates of MSF to maintain a balance in the economic condition of the country. During its introduction in May 11, the interest rate of MSF was 100 bps higher than the repo rate, and by paying this rate, banks could get up to 1% of their NDTL. But in July 2013, RBI increases the MSF rate to 300 bps, that is 3% more than the repo rate, to manage the falling value of the rupee. Later, in another amendment, the central bank has reduced that to 50 basis points, which made it easier for the banks to get money from RBI whenever they were in need of immediate funds. As per the amendment in RBI monetary policy done on 4th October 2017, the MSF rate is fixed at 6.25, which is 25 bps more than the repo rate, and the current MSF rate stands at 4.25, which is again 25 bps more than the current repo rate, which is 4%. Let's see the differences between MSF and repo rate. The difference between the MSF and repo rate is that MSF is used only in the emergencies. The RBI does this to control interest rate volatility by allowing commercial banks to borrow against government securities at a higher rate than the prevailing repo rate. The minimum amount for which MSF is approved is rupees 1 crore, whereas at least 5 crore is borrowed in LAF or repo rate. There is no maximum limit for repo rate, as bank borrow according to the securities, but maximum limit for MSF is up to 1% of NDTL. Next is MSF is required for very short time, that is overnight, and for the time duration for repo rate is 14 days at max. Another difference with the repo rate is that banks can pledge government securities from the SLR quota up to 1% under the MSF. Next, only scheduled commercial banks can bid for MSF, whereas all banks are eligible to bid for repo rate. And as per the latest notification of RBI on 4th December 2020, both LAF and MSF will be introduced for scheduled regional rural banks also. Yes, but definitely there is some eligibility criteria for these RRBs, like these banks must have implemented core banking services, and there should be a minimum capital to risk weighted asset ratio, that is CRAR, of 9%. Now see the final slide, that is key differences between repo rate and bank rate, which is again very important. Though repo rate and bank rate have a few similarities, like both is fixed by the central bank and used to monitor and control the cash flow in the market, they have some prominent differences too. First is, bank rate is charged against loans offered by the central bank to commercial banks, whereas repo rate is charged for repurchasing the securities sold by the commercial banks to the central bank. Next is, no collateral is involved while charging bank rate, but securities, bonds and other agreements are involved when repo rate is charged. Repo rate is always lower than bank rate. And comparatively, bank rate caters to long-term financial requirements to commercial banks, whereas repo rate focuses on short-term financial needs. So, we have discussed all the important quantitative methods of credit control. I have tried my level best to finish this interesting topic within limited time with important explanation, and I'm sure you must have learned these concepts. And now finally, if you liked the video, then surely give a thumbs up and also share with your friends and all those people who can be benefited with this topic. And do subscribe the channel for more important and interesting contents. We will meet soon. Till then, maintain social distancing and stay safe. This is Bhavna Mehra signing off.